I'm reading within the Reference Guide to Regulatory Compliance, Transactions with Affiliates, Reg W. I ended at letter J, rules applicable to financial subsidiaries of the bank. And that's just within the requirements of Section 23A. And when we say 23A, we say 23A of the Federal Reserve Act, not Reg W, as I presume, if I'm presuming correctly. Exemption from the 10% limit. The 10% limit for covered transactions does not apply to transactions between a bank and a financial subsidiary. The 20% aggregate limit on transactions between the bank and all affiliates does not apply to such transactions. 2. Valuation of purchases or investments in the securities of a financial subsidiary. General rule. A bank's purchase of an investment security issued by a financial subsidiary of the bank must be valued at the greater of the total amount of consideration given in exchange for the security, including liabilities assumed by the bank, reduced to reflect amortization of the security in accordance with GAAP, and to the carrying value of the security. B. Carrying value of an investment in a consolidated financial subsidiary. If the financial subsidiary is consolidated with a parent company under GAAP, the carrying value of the bank's investment in securities issued by the financial subsidiary will be equal to the carrying value of the securities on parent-only financial statements of the bank. Number 3, under rules applicable to financial subsidiaries of the bank, is treatment of affiliates' investments in and extensions of credit to a financial subsidiary of a bank. A. Investments. Any purchase of or investment in the securities of a financial subsidiary of the bank by an affiliate is treated as a purchase of securities by the bank. B. Any extension of credit to the financial subsidiary of a bank by an affiliate of the bank is treated as an extension of credit by the bank to the financial subsidiary subsidiary if the credit is treated as capital of the financial subsidiary under any application of federal or state law. Letter C. Any other extension of credit to a financial subsidiary of the bank by an affiliate of a bank will be treated as an extension of credit by the bank to the financial subsidiary if the Financial Reserve or the Federal Reserve determines that such treatment is necessary to prevent evasions of the Federal Reserve Act. Derivative transactions, letter K. Market term requirements. Derivative transactions between a bank and its affiliates other than depository institutions are subject to the market term requirements of Reg W. Policies and procedures. The bank must establish and maintain policies and procedures designed to manage the credit exposure arising from derivative transactions with affiliates in a safe and sound manner. These policies and procedures must provide for A. Monitoring and controlling credit exposure at any one time from the bank's derivative transactions with each affiliate and all affiliates' transactions in the aggregate through, among other things, imposing appropriate credit limits, mark-to-market requirements, and collateral requirements. And B. Ensuring that the bank's derivative transactions with the affiliate comply with the market term requirements of Reg W. Number 3, credit derivatives. A credit derivative between a bank and a non-affiliate in which the bank provides protection to the non-affiliate with respect to an obligation of the affiliate of the bank is guaranteed by the bank on behalf of the affiliate. These include an agreement for the bank in exchange for a fee to compensate the non-affiliate in case of default by the affiliate. And B, an agreement under which the bank, in exchange for payment, agrees to pay the non-affiliate a spread over funding costs plus any depreciation in value of the underlying obligation if the obligation of the affiliate. Letter L. Although the following transactions between affiliates are exempt from quantitative limits and collateral requirements of Reg W, they remain subject to both the safety and soundness requirements and the prohibition on the purchase of a low-quality asset. That's number 1. Transactions with a depository institution if the bank controls 80% or more of the voting securities of the depository institution, or the depository institution controls 80% or more of the bank's voting securities. Number 2, transactions with a depository institution if the same company controls 80% or more of the securities of the bank of the depository institution. Number 3, purchases of loans on a non-recourse basis from an affiliated depository institution. And 4, purchases of assets from an affiliate if A, the asset purchase is part of an internal corporate reorganization of a holding company and involves the transfer of all or substantially all of the shares or assets of an affiliate or a division of an affiliate. B, the bank provides written notice of the transaction to its federal banking regulatory agency and the Federal Reserve before consummation of the transaction. And C, the bank's top-tier holding company has committed to its federal banking agency and the Federal Reserve before consummation either to make quarterly cash contributions to the bank equal to any transferred assets that become low-quality assets, or to repurchase those assets on a quarterly basis during the first 2 years. D, the bank's top-tier holding company complies with this requirement to repurchase low-quality assets. E, the majority of the bank's directors reviewed and approved the transaction before consummation. F, the value of the covered transaction when aggregated with other covered transactions of the bank under this exemption during the preceding 12 calendar months is less than 10% of the bank's capital stock and surplus. G, the holding company and all subsidiary banks and depository institutions are well capitalized and well managed and would remain well capitalized on consummation of the transaction. Letter M, covered transactions that are exempt from the quantitative limits, collateral requirements, and low quality asset prohibitions. 1. These are covered transactions that are exempt from these sections. 1. Making a deposit in an affiliated depository institution or affiliated foreign bank maintained in the ordinary course of correspondent business. 2. Giving immediate credit to an affiliate for uncollected items received in ordinary course of business. 3. Engaging in credit transactions secured by segregated earmarked deposit accounts in the bank or by U.S. government securities. 4. Purchasing a security of a servicing affiliate. 5. Purchasing a liquid asset that has a readily identifiable and publicly available market quotation at or before the current market quotation, at or below the current market quotation. 6. Purchasing a security from a securities affiliate if A, the security has a ready market, B, the security is eligible for a bank to purchase, C, the security is not a low-quality asset, D, the bank does not purchase the security during or within 30 days of an underwriting if the affiliate is an underwriter, and E, the securities price is quoted routinely on an unaffiliated electronic service providing indicative data from real-time financial networks. F, the security is purchased at or below the current market price. G, the size of the transaction does not cast material doubt on its appropriateness. And H, the bank maintains records and supporting information for 2 years. 7. Purchasing municipal securities if the following conditions are met. A, the security is rated by a nationally recognized statistical rating organization or is part of an issue that does not exceed $25 million. B, the security is eligible for purchase by a bank. C, the price is quoted routinely on an unaffiliated electronic service providing indicative data from real-time financial networks. D, the price paid is at or below the market price. E, the size of the transaction is not inappropriate. F, the price of the exact security to be purchased can be identified by reference to two or more actual current price quotes from non-affiliated broker-dealers. G, the price paid can be verified by reference to the written summary provided by the syndicate manager to the members that discloses the aggregate values and prices. 8, under covered transactions that are exempt from quantitative limits, collateral requirements, and low-quality asset prohibitions, is purchasing from an affiliate an extension of credit that was originated by the bank and sold to the affiliate with a repurchase agreement. 9, purchasing an asset from an affiliate with approval from the appropriate federal banking agency when the purchasing bank has been newly formed. 10, conducting a merger or consolidation between a bank and an unaffiliated depository institution or U.S. branch or agency of a foreign bank if the transaction has been approved by the appropriate federal banking agency. 11, purchasing from an affiliate an extension of credit if A, the credit was originated by the affiliate, B, the credit makes an independent evaluation of the creditworthiness of the borrower before committing to purchase the credit, C, the bank commits to purchase the credit without recourse before the affiliate makes or commits to make the extension of credit, and D, the dollar amount of the credit when aggregated with all other credit purchased from the affiliate within the past 12 months does not represent more than 50% of the amount of extensions of credit originated by an affiliate during that 12-month time period. 12, providing intraday extensions of credit to an affiliate, provided the bank has established and maintains policies and procedures to manage the credit exposure arising from these transactions, including A, monitoring and controlling credit exposure arising from intraday extensions of credit to each affiliate and all of them in aggregate. B, ensuring that any such credit to an affiliate complies with the market term requirement of Reg W. C, having no reason to believe that the affiliate will have difficulty repaying the extension of credit in accordance with its terms. And D, ceasing to treat any such extension of credit as an intraday extension of credit at the end of the business day. 13, making riskless principal transactions in securities purchases involving an affiliate. A, the bank or the securities affiliate acts exclusively as a riskless principal in a transaction. And B, the security purchase is not issued, underwritten, or sold as principal by the affiliate of the bank. Additional exemptions under Section 23A. The Federal Reserve may exempt other transactions if it finds the exemption to be in the public interest and consistent with the purposes of 23A. 2, a bank may request an exemption by submitting the request to the General Counsel of the Federal Reserve. The request must describe in detail the transaction or relationship for which the bank seeks the exemption, and B, explain why the Federal Reserve should exempt the transaction or relationship, and explain how the exemption would be in the public interest. O, notification to OTS. The OTS may require Savings Association to notify the agency before engaging in a transaction with an affiliate. Not so anymore. Subpart 3, requirements of 23B, which is, I guess, subpart F under Reg W. The Federal Reserve Act. A, letter A, market term requirements. The following transactions are subject to the market term requirements. 1 through 5. Any covered transaction with an affiliate, including transactions with non-affiliates where the proceeds are used for the benefit of or transferred to an affiliate, unless the transaction is exempt. 2, the sale of a security or other asset to an affiliate, including assets subject to repurchase agreements. 3, the payment of money or furnishing of a service to an affiliate under a contract, lease, or otherwise. 4, any transaction in which an affiliate acts as an agent or broker or receives a fee for its services. 5, any transaction with a non-affiliate if an affiliate has a financial interest in the affiliate. B, is a participant in the transaction. Letter B, requirements. A bank may not engage in a transaction covered by this section unless it is on terms and conditions that are substantially the same or at least as favorable to the bank as those prevailing at the time for comparable transactions involving non-affiliates, or 2, in the absence of comparable transactions on terms and under circumstances that in good faith will be offered to a non-affiliate. C, prohibited asset purchases. A bank may not purchase as fiduciary any security or other asset from any affiliate unless the purchase is permitted. A, under the instrument creating the fiduciary relationship by court order or by the jurisdiction governing the fiduciary relationship. Number 2, whether acting as a principal or as a fiduciary, a bank may not knowingly purchase or require during the underwriting any security if a principal underwriter of that security is an affiliate of the bank. However, a bank may purchase a security during the underwriting process even if the underwriter is an affiliate, provided the purchase has been approved in advance by the directors of the bank before the initial offering or sale to the public. And B, the approval is based on a determination that the purchase is a sound investment for the bank. And C, a majority of directors periodically reviews these acquisitions to ensure that they continue to meet the standards and that the standards continue to conform to the required criteria. Advertisement section, restrictions. Part D, a bank and its affiliates may not publish any advertisement or enter into any agreement suggesting that the bank will be responsible for the obligations of its affiliates. 2, the bank may issue a guarantee, acceptance, or letter of credit on behalf of an affiliate to enter into a cross-affiliate netting arrangement as long as the quantitative limits and collateral requirement are otherwise met. E, standards for exemptions from 23B. The Federal Reserve Board may exempt transactions or relationships from Section 23B requirements if it finds that such exemptions are in the public interest. And letter F, application of Sections 23A and 23B to U.S. branches and agencies of foreign banks. 23A and 23B apply to foreign banks engaged in underwriting insurance, underwriting or dealing in securities, merchant banking, or insurance company investment in the U.S. in the same manner and to the same extent as if the entity were a bank. Enforcement, fear of penalties. Penalties up to $7,500 per day for violations of laws and regulations. B, penalties up to $37,500 per day if violations or unsafe or unsound practices are engaged in recklessly or part of a pattern of misconduct that causes more than a minimal loss to the bank or any pecuniary gain to the parties involved. C, penalties up to $1.375 million per day against persons who knowingly commit a violation and knowingly or recklessly cause a substantial loss to the bank or substantial benefit to the party. That's the end of Reg W, by the way.